Hello everyone. My name is Mariska Maulani, NPM 23411108, Management Class 23B. Here I will explain the material about the transfer pricing.
Hello, my name Mariska Maulani from Class Management 23B. Telephoning is a means of communication using telephones or other devices to connect with people remotely. It allows for real-time conversation over long distances, facilitating business discussions, personal chats, or seeking information from various services. Whether it's a casual conversation or formal call, effective telephoning involves clear communication, active listening, and polite conversation etiquette. Telephoning materials are usually rarely used when contacting people closest to you. However, it would be very useful to learn when contacting important people or clients. The telephoning material and examples are as follows. 1. Answering call. Answering the telephone. When someone calls you, of course you will answer the phone after the caller has spoken or spoken first. An example of how you answer the telephone is as follows. Good morning, this is Tara. Good afternoon, Cindy. How much can I...
Objectives of transfer pricing. Transfer pricing serves several legitimate business and fiscal purposes. However, it can also be misused if not properly monitored. Below are the primary objectives of transfer pricing. Allocating profit internally within a corporate group. Different entities contribute differently in terms of functions, assets, and risks. Transfer pricing helps allocate profits fairly among entities based on their economic contributions. This allows each business unit's financial statements to reflect its actual performance. Optimizing tax burden. One of the most common motivations behind transfer pricing is tax efficiency. By shifting profits to jurisdictions with lower tax rates, companies can reduce their overall tax liability. While this strategy can be legal if it adheres to the arm's length principle, it can cross the line into tax avoidance if manipulated improperly. Evaluating business unit performance. Transfer pricing serves as a managerial tool to assess the performance of individual business units. For example, a manufacturing division and a sales division can be evaluated independently based on internal pricing structures. Operational and financial efficiency. Proper transfer pricing enables companies to manage resource flows, cash management, and internal logistics more effectively. This is crucial for multinational corporations that operate under different tax systems, currencies, and trade regulations. Related parties in transfer pricing. In transfer pricing, it is essential to determine who qualifies as a related party. According to international standards and most tax laws, entities are considered related if one entity directly or indirectly owns 25% or more of another entity. One party exercises significant control or influence over the management, financial policies, or operations of the other. There are family relationships between individuals controlling the entities. There are shared economic interests or cross-ownership between the entities. These relationships mean that transactions may not be conducted at arm's length, increasing the risk of price manipulation and tax base erosion. Legal and tax implications of transfer pricing. Transfer pricing is not only a business issue but also a major concern for tax authorities. If a transaction is not conducted at arm's length, meaning it does not reflect fair market value, tax authorities may intervene through various mechanisms. Transfer pricing adjustments. Tax authorities may recalculate the income and tax liability of a company by comparing the transfer price used with a reasonable market price. If a significant discrepancy is found, profits may be reallocated and tax liabilities increased. Imposition of penalties and sanctions. If improper transfer pricing practices are identified, whether due to negligence or intentional avoidance, authorities can impose administrative penalties, interest charges, and even initiate legal proceedings. International tax disputes. In multinational cases, a transfer pricing adjustment by one country may not be recognized by another. This can lead to double taxation and international tax disputes, which require resolution through mutual agreement procedures, MAP, or tax treaties. Conclusion: transfer pricing plays a vital role in global business management by ensuring internal financial efficiency, performance measurement, and strategic tax planning. However, because of its potential for misuse, it is subject to strict regulations and requires thorough documentation to ensure compliance with the arm's length principle. Governments around the world, including Indonesia, have implemented detailed transfer pricing documentation requirements and reporting obligations to prevent tax base erosion. Therefore, a solid understanding of the principles, objectives, and risks of transfer pricing is essential for corporate managers, tax professionals, and policymakers. That's all the material I can convey. I apologize if there are any wrong words. I'll end it. Thank you. See you again.